Hello, Internet friend. Today on Value Side, Why Manufacturing Left America. I'm David Ravel. Well, nearly a century ago, Austrian economist Joseph Schumpeter observed that capitalism has two fundamental processes, both construction and destruction. Not only are enterprises created, but some are destroyed. Furthermore, destruction may come from several different directions: a loss of customer, supply chain issues, or, as we'll see, from a lack of capital. Today we'll explore the story of how one of New England's premier businesses, one that employed 12,000 workers, was shut down by its owner, who had found better alternatives for its capital. This discussion is especially relevant now as President Trump seeks to revive some of those long-forgotten manufacturing businesses. Today, the story of Berkshire Hathaway, the textile mill that gave its name to one of the most significant conglomerates, and how Warren Buffett decided to close its doors. Well, it would be years before I learned that Berkshire Hathaway had been taken over by one of the premier investors of all time, Warren Buffett. Buffett had identified Berkshire as an undervalued company that made a worthwhile product. And at that time in his evolution as a portfolio manager, Buffett was renowned for buying what some on Wall Street labeled as cigar-butt companies, companies that were not particularly attractive or scintillating, but produced positive financial results year after year. It was the type of investing that became known increasingly as value investing, putting your money with companies that weren't likely to grow to the moon, but also were not likely to lose money either. This conservative approach, focused on little-noticed backwater investments, was especially popular with investors who had just endured the dismal markets of the 1970s. It is a perspective that is almost incomprehensible to today's investors, entirely out of sync with the prevailing thinking on Wall Street, where nearly everyone's objective is to maximize profits. However, these old-line investors who had been through the fire, investing at a time when profits were scarce, but losses mounted quickly. They had seen a stock market that remained flat for a decade, having first surpassed the magic 1,000 level in 1966, repeated that level again in 1972, but remained below that peak until 1982, a decade without progress, a time when brokerage firms failed and mutual funds went out of business, and many investors forgot what profits were. Investing in a company like Berkshire Hathaway, with its paid-in-full mills and loyal customers, made lots of sense. Steady results proven over the decades. However, by the dawning of the 1980s, a new wind was beginning to blow across the country. In Washington this time was different. It was becoming fashionable to be successful, and it was suddenly acceptable to drive at full speed on the turnpike, to stay comfortably warm in winter, and to strive for wealth. The old thinking was retired, and with it ways of thinking concepts like stagflation were not to be heard again for a generation. President Ronald Reagan brought a new perspective, promoting the private sector, reducing taxes and regulation, and revitalizing the economy, particularly on Wall Street. The Reagan Revolution introduced new investment strategies, paving the way for a revolution in how we plan for our later years. All of those retirement accounts that we now take for granted began then: the IRA, the 401k, the Keogh, and other investment accounts. People who had never considered investing were now setting aside funds for their retirement. Investment managers and advisors observed that retirement assets often matched or even exceeded those in traditional investment accounts. Times had changed, and in what was likely his most prescient moment, Buffett adapted to the change. For years, Buffett's partners and the vice chairman of Berkshire Hathaway, Charlie Munger, had admonished that it was better to invest in good companies at a cheap price rather than cheap companies. It was a lesson that Buffett observed daily in the 1980s as the financial results of the Hathaway Mill companies continued to underperform. Month after month, the textile business saw margins squeezed as offshore makers and aggressive retailers forced price concessions. Tragically, it wasn't anyone's fault. Buffett had hired skilled managers, the mills themselves were in good conditions, and the laborers worked diligently. But still, profits lagged. It was then that Buffett realized that his investment model was at fault. The decision to invest in can't lose needed to change. Likely to win was a more rational approach. In 1985, Buffett decided to close Berkshire Hathaway, the company's namesake. Addressing his shareholders, Buffett put it this way, quote, "Likewise, a textile company that allocates capital brilliantly within its industry is a remarkable textile company, but not a remarkable business." My conclusion, said Buffett, from my own experience and from much observation of other businesses, is that a good managerial record is far more a function of what business boat you get into than it is of how effective you row. Unquote. No doubt for Buffett, this acknowledgment was a bitter pill. It was one of the few real losses that he had suffered in his career. It indicated an entirely wrong approach, one that he would not suffer again. The closure of the old Berkshire Hathaway marked a secular transformation not only for investors, but for the American way of business. There was a time when textile mills of New England were at the very apex of industry and commerce, the source of wealth and income for the owners and the workers of the mills. But that time had come to an end, and Buffett now knew it. Capital is often the first to recognize a transition, and Buffett's move did not go unnoticed on Wall Street, where investors gradually fled the American textile business. Of course, the textile industry isn't the only field that has seen the outmigration of American capital. Nearly all of the country's basic manufacturing has lost investor support. It's hard to think of a single manufacturer, with the possible exception of Tesla, that has acquired Wall Street support. Indeed, entire industries, ranging from consumer electronics to basic household goods and low-price consumer items, are manufactured now overseas. Why? Although there are many factors contributing to this flight from the U.S., at least some of the reasons are that foreign capital, offshore investors, do not have the same investment criteria as we have in America. Along with Warren Buffett, we voted with our wallets decades ago, indicated that we wanted returns far above those of any conventional manufacturer. You need to look no further than the stock market to see where America puts its money. Today, this country has it all riding on the Magnificent Seven, the world's most expensive group of high-tech companies. Nearly 1 in every $3 invested in the stock market goes to the Mag 7. As a result of this focus, each Mag 7 company is currently valued at more than $1 trillion, a level first achieved by Apple Computer just 7 years ago. NVIDIA, the AI chip maker, currently has a market capitalization of over $4 trillion, a level 100 times greater than America's formerly dominant manufacturing company, Ford Motor Company. It should come as no surprise, then, with a surplus of capital, companies like Apple, Microsoft, Alphabet, Facebook, Amazon, Tesla, and NVIDIA, among others, will continue to expand and develop their products and services. However, it should be equally apparent that companies starved of capital, such as Ford, General Motors, and others, will likely suffer. Ultimately, capital has proven to be the decisive factor between success and failure for American enterprise. And to the extent that investors allocate capital away from some, as Buffett did for Berkshire Hathaway, and towards others, like the Mag 7, lies our economic future. Who can argue with Buffett's investment success? And that's today's Value Side. For all of our articles, references, and podcasts, visit valueside.com. I'm David Ravel. ValueSide is independently written and researched. The views expressed are strictly my own.